Okay. So you guys should be seeing my slides real quick. My bright yellow screen. This information is accurate as of today, as accurate as I can make it. Remember, during our sessions, some of what I share with you is my opinion or processes in my firm. They're not necessarily representative of how Pronto Tax does things or how you do things. When it comes to, well, whatever. We try to make it as accurate as we can. Y'all know the drill. You've seen the screen a million times. Okay, so let's talk S Corporation basis. It's not important to track, right? Like nobody needs to know that. I can't tell you how many S Corp clients have come to me with no basis schedules. Their previous preparer did not provide them, or in some cases, much to my shock, when I did reach out to that previous preparer, they just replied that they never tracked it. Excuse me. I don't know about you guys, but every tax software that I've used, and I'm up to a whopping 3 different softwares now, they all have basis schedules. So tracking basis should be a thing. And I would encourage you, if you are offering S Corporation tax preparation services or partnerships, we're not going to touch on partnerships today because that's a whole complicated, more than 1 hour training session. I would encourage you to be providing your clients with those basis worksheets as part of their K1s if you're not already doing it. Okay, so we're going to again talk about what is S Corporation basis, why is it important, how to calculate it. We're going to do kind of a high level example. Again, we only have about 50 minutes to go through this, so that doesn't give us time to go into every potential scenario. And then what to do when a client doesn't know what their basis is. A lot of words on this screen. Y'all know I hate death by PowerPoint, but I'm going to provide these slides to Imelda if I haven't already, so we'll make sure that she has these. Short answer, basis is the shareholder's investment in their corporation. That's just the very brief definition. For S Corps, there's 2 types of basis, stock basis and debt basis. I want to point out, because I see this asked a lot and I see it handled incorrectly a lot, loans taken out by the S Corporation do not create debt basis for the shareholder. Even if they personally guarantee the loan, doesn't matter. So for example, all those EIDL loans that were issued during COVID, those loans were issued to the company. That does not create debt basis. That's why we saw a lot of distributions in excess of basis, because people were taking those EIDL funds and taking distributions when they didn't have enough basis to cover them. So debt does not create basis if the debt is issued to the S Corp. An alternative approach, if you have a client who's trying to take out a loan and they're debating how to do it, if they took out the loan individually and then legitimately made a loan to their S Corporation, so a true shareholder loan, we're talking properly documented market interest rates, right? An actual loan with a loan document, then it creates debt basis. So if your client has the opportunity to do one way or the other, you may want to investigate whether it makes sense for them to take out the loan as an individual and then loan the money to the S Corporation. In that scenario, to keep all of the proper things in their proper boxes, the S Corporation should not make the loan payment directly to the lender. They should make a loan payment to the shareholder, and the shareholder makes the payment to the lender. It's 6 of one, half a dozen of the other if your client pays it directly, but I like to keep things in their proper buckets. And if they're trying to say that it's an arm's length transaction, a true loan, then all the payments should be made to the right parties. That's my 2 cents. I don't know. There may be some code section that says that. Probably not. So that's just my advice. Do with that what you will. So in short answer, Jeremy, can you share with everyone why it's so important to track S Corporation shareholder basis?
Yeah, sure. So probably the 2 most common things that we see, especially over... We started seeing a lot more of this in 2023, preparing 1120Ss and the shareholders 1040s. Started seeing a little bit of it in 22, but 21, 22, for a lot of the clients we work with, they were having pretty good years through their S corporations. 23, things started to turn south for a lot of them. A lot of the online businesses, a lot of the fractional CXO businesses, coaching businesses, creators, business took a turn when COVID kind of went away. And so when the pandemic went away. And so they were sort of operating as they'd gotten used to over the prior couple of years. And two things started to happen. One, their businesses on paper, at least, just started losing money. A couple things caused that. One was they had set reasonable compensation at certain levels during those couple of years and not really gone back and changed that. And so they wound up, even though they were cash flowing personally from the business, they wound up with losses on the 1120S. Without basis, those losses aren't deductible for the shareholder. If those losses are passing through on a K1 and there's no basis to cover that, those losses get suspended. The other thing is distributions. And so some of them had gotten used to a certain amount of pulling cash out of their businesses. They'd gotten used to a certain level of cash flow. And again, if the revenue isn't there to generate enough profit to cover those distributions, now they're in a situation where they're distributing more cash to themselves than the business is generating profit, which can quickly turn into a situation where you've got distributions in excess of basis. And so those two things started coming together for a lot of. So they were getting squeezed in the middle of just declining profitability and even net losses on the 1120S, combined with still needing to pull cash out of the business, and so taking distributions in excess of basis. And that's especially true, as Andrea said, if that S Corp has any sort of debt on the balance sheet, because they're not getting any basis for that. And so you start to see the credit card balances go up. You start to see some short-term loans show up. You start to see some other types of loans show up on the balance sheet, and the cash is still coming out to the shareholder, but there's no profit to cover all that.
And for those of you who haven't had to deal with distributions in excess of basis, when that happens, on the personal return, it's reported as a capital gain, and it's subject to capital gains tax. So while, yes, technically distributions are tax-free, as you see written out a lot, they could be subject to tax in certain circumstances. And I don't know about you guys, but in our firm, we're seeing those circumstances happening more and more often. Like Jeremy said, it's kind of I think a lot of people expected to have tough years during the COVID years, and a lot of people's businesses actually did really well, especially online businesses, since nobody could go shop in person. And they haven't made adjustments for the downturn in their business since everything reopened and since people are getting back to normal. So we're seeing it happen a lot. And in some cases, pretty significantly. I mean, I think I've seen distributions in excess of basis $30,000, $40,000, $50,000. So we're not always talking about small amounts here, and those can have a pretty significant impact. Also, if it's tax projection season for you and your firm, like it is in our firm, this is a great time to be including in your tax projection that basis analysis. If you don't have access to your client's books, have them provide you with a current P&L and figure out if they have distributions in excess of basis. You're going to need their balance sheet too, but go ahead, Jeremy.
And I'd throw in reasonable compensation too. So for the S Corps that I've done the books for, I put owner compensation. Sometimes I see it mixed in with all the rest of the payroll. If there are other employees, I always separate that out. And in fact, if your bookkeeping software allows it, I put that as an other expense so that it's all the way down at the bottom. That gives me an idea of what operating net income is versus actual net income. And I can quickly compare those two numbers. And yeah, if we get into September, October, November, and we're seeing that net operating income is X and reasonable comp is causing a loss there, then we need to make some adjustments.
And this is also maybe a good time if you're already doing tax projections and you're already having meetings with your clients and talking through things. If you are an RC Reports user, this might be a good time to do an updated reasonable comp survey to make sure that the number that you're shooting for is still on point. And then that can help you when you're making your adjustments. So just a quick little plug there. Y'all know I love some RC reports. Okay, so Jeremy, can you walk us through a very high level explanation of how basis is calculated from like day one, started a company and elected S corporation to the end of the year?
Absolutely. So back to what Andrew was saying before about the basis schedules. Yeah, if you're preparing the 1120S, you should absolutely be putting that basis information in there so those schedules are calculated. If you're preparing the 1040 and you've got clients that are getting in K1s from an 1120S, and there's not a basis schedule attached to that, you should absolutely be getting that taxpayer to ask for one from the firm that prepared the 1120S. Ultimately, it is the shareholder's responsibility to track that basis. This is something that gets reported on the 1040. And in fact, for the last couple tax years, we've had a new Form 7203, that does this. So it's no longer just a schedule that's sort of optionally attached to the return. There's actually a full-fledged form now that has to be attached to the 1040. I'm seeing a lot of softwares that will attach this to the K1. So the software that's prepping the 1120S will attach the 7203 to the K1. You can use that, but I wouldn't rely on that 100%, especially if that S Corp, if that shareholder is a new client to you and they've been in business through that S Corp for a few years. I would want to go back and make sure, verify at least what that beginning basis is on that 7203. So what is basis then? The first thing to remember with a brand new S corporation, and this is true of the year that that entity elects S, if it's already been, if that entity has already been in business and for a year or more, and then it elects S, beginning shareholder basis is always zero. This is another thing that I'll see often is, especially for a business that's already been in operation and then it elects S, is by some means, right? Whatever carried over from that prior entity is magically beginning basis, and that's not true. Beginning basis is always zero. Then we add to that anything that's going to increase basis. So those initial contributions. And again, this is true of a business that's electing S that's already been in operation. That's actually a Section 351 transfer. Section 351, that's in subchapter C. That's the C corporation part of the IRC, of the Internal Revenue Code. But subchapter S, which is what gives us the rules for S corporations, references back to subchapter C. So a lot of the rules, not all, but a lot of the rules that govern how C corporations are taxed and treated by the tax code, those are actually pulled into subchapter S. So a lot of times when we're thinking about how things work for S corporations, again, if it's not explicitly a different rule for S corporations, we have to go back and look at subchapter C. And so that S election is actually a two-step process. We only see it as one with that S election, Form 2553, but what actually happens is two steps. One, that entity elects to be a C corporation, and then it also, at the same time, elects to be an S corporation. So that Section 351 transfer is taking us through those two steps separately. The first thing is whatever that entity was before, whether it was a sole proprietorship or a partnership, now it's becoming a C corporation. So whatever the net assets, whatever the assets and the liabilities, not the net assets, whatever the assets and liabilities of that prior entity are being contributed to in a tax-free transfer, generally a tax-free transfer, into that C corporation. When that happens, that's where we get that initial contribution into the S corporation, right? So typically what we're seeing with a lot of our businesses, a lot of our clients, is that they've got some cash in the bank and maybe a credit card balance. $20K of cash, $10K of credit card balance. You got that initial contribution into the C corporation initially of $20,000 cash, $10K in credit card, and then that becomes an S corporation. So that initial contribution is what is going to first create stock basis for that shareholder. Then as the tax year goes on, we're going to add any other capital contributions they make. We're going to add the net income. If the business is profitable for tax purposes, we're going to add the net income. And then from there, we're going to start looking at the things that take away from basis. And we always start with distributions. Distributions come first in what we start taking away. And this is important later on when we start thinking about whether those losses from an S corporation are deductible for that shareholder or not. So the first thing that comes away are distributions. And then after that, we look at the non-deductible expenses. And then we look at look at anything else that's remaining from those pass-through items, from those separately stated items.
So really quick on that, there are ordering rules. Jeremy just alluded to that. You deduct this first, then this, and that can become important when figuring out if the losses are deductible. Just two quick points I wanted to make. Back to the 7203, the basis schedule with the K1, your software may require that you check a box to include that in the K1. Not all of them print it automatically. I think it might have been a setting in Drake. So make sure that you check your settings, your print settings, and that when you give K1s to your clients, you're including that 7203 or debt basis schedule or whatever, or stock basis schedule, whatever your software calls it. I highly recommend that you're giving that to your S Corporation clients when you give them their K1. The second thing I wanted to mention, and Jeremy also talked about this, we talked previously, for us, most of our clients were an LLC first, and then we elect S Corporation status, or they did before they came to us. We've talked before about how to handle that in the books. There are a bunch of ways to skin that cat, but generally speaking, what I like to do with our clients is in the final year as an LLC, single member LLC, multi-member LLC, whatever, not as an S Corp, I'm going to make a journal entry to close out all of the assets and the liabilities. And then I'm going to put in a new entry on 1/1 of the first year that the S election is effective. So obviously this is the case if they've already been in business, right? If they were in business for a few years and then elect S Corp. And then on 1/1 of the first year of the S Corporation, I'm going to make a journal entry to contribute those assets and add those liabilities, that Section 351 transfer that Jeremy was talking about, to set up the initial balances as an S Corp. You don't have to start a whole new set of books, but I do generally like to have a nice clean line. And that also helps make sure the balance sheet ties out to the Schedule L on the tax return, because all of those beginning balances are going to be zero.
I think it's also on that note. Just one more point here, I think it's really important. This is something that I see a lot of practitioners struggle with, especially when they're prepping 1120Ss for the first time. Is there are actually 4 different numbers that go on here when we start talking about basis that are all interrelated, and they're similarly calculated, but they're different. Basis, shareholder basis, especially if it's a solo S Corp, right? There's only one shareholder with basis. Or we can just look at net basis across all the shareholders. Equity, right, which is going to show up on the Schedule L. Retained earnings, which is part of that, and then the accumulated adjustments account, or AAA. All of these amounts, usually they kind of track together, especially as the S Corp is making money, right? If there's profit every year and the S Corporation was elected fairly early, if not at the very beginning of this entity, they usually track pretty closely. But it's very easy for one of them to have something that's part of the calculation for that value that's not with the others, and you can quickly get some differences. And this will throw a lot of 1120S preparers off, because they get used to seeing those numbers track each other pretty closely, and they'll say, well, wait a minute, basis can't go below 0, AAA can't go below 0, except sometimes it can, because losses can take AAA below 0, but not distributions, whereas basis can never go below 0. Retained earnings, if the business has never really had a profitable year, retained earnings can be negative. I've seen negative 6-figure numbers on 1120S Schedule Ls, whereas basis is never going to go below 0, and AAA, it depends on what's driving either that negative or that 0 amount. So sometimes we expect those numbers to track, sometimes we don't. So don't compare those numbers directly like they're all the same and think, oh, I must have done something wrong if they're not lining up, especially if there are losses or distributions in excess of basis. Those can really cause some problems for those numbers all lining up the way we tend to want them to, even though we
also saw some adjustments in the AAA account when PPP forgiveness was happening. The way PPP forgiveness was reported, it affected that AAA column. So you're going to see some wonky numbers, especially post-COVID, because again, those EIDL loans allowed people to generate losses, take distributions in excess of basis, PPP forgiveness. It was like the wild, wild west. So for those of you, and then Andy, I see your hands up, so we're going to come to you. For those of you who have not yet started preparing entity tax returns, who's like super excited to dig in? This is for sure going to make you want to do that. All right, Andy, what's up?
Yeah. Hey, thanks a lot for this topic. And thanks, Jeremy, for joining us and sharing your expertise. Really appreciate it. Great discussion. So I wonder if a good topic for a follow-up to this, you're mentioning like the journal entries that you make because most commonly we're seeing, at least in our business, is, they start as an LLC or a sole proprietorship, but more and more it seems like it's LLCs, like you said, Andrea, that they then they're converting to an S corporation. The things that you talked about, like the journal entries and the closing of the LLC books in a certain way that you talked about, that would be great to see that like in the wild, so to speak.
Yeah.
But how much of the basis problems, it's almost like, because with these different business types of returns, right, I feel like we need to look in certain areas where there's most commonly a problem, right? Like, and so would you say that with those kinds of businesses, it's almost like that was never done, right? It was never like addressed. Like nobody knows about things like the 351 that Jeremy's talking about. Like it just kind of was like the books just kept going, right? And whatever, there was nothing of what you're saying like actually happened, right? So as a tax professional, do you feel like we need to kind of like track back to that point and say, and like identify, was any of that done? Could we do any of that now? It seems like an area that really caused a lot of issues that I know for my business, we're not like addressing that as successfully as you just described it. Does that make sense?
It does. Yeah. Go ahead, Jeremy. I know you got
I was about to say, I have a sort of unofficial list, and I need to actually type these all out at some point in my head of red flags, especially with new clients coming in, or when I was doing tax returns, especially entity returns for entities that I wasn't doing the books for. So it's things that seem really little to others, right? To non technical tax professionals, but you realize. So, for example, one of them that I was talking about the other day was when I still see meals and entertainment expense on the P&L, right? And we haven't had a combined meals and entertainment expense since 2017, right? Since 2018 with Tax Cuts and Jobs Act. So if I see that, I know that there's an issue, especially if this is an entity that's been around for a while, because nobody's ever gone back into the books and corrected that, right? No tax professional has reached out to that business owner or that bookkeeper and said, hey, we need to fix this part of your books. And so you're absolutely right. So like a new 1120S, where new to me 1120S, where we see, there might be issues with basis, there might be issues with the way AAA has been calculated. I mean, they're not necessarily you did something wrong, but they're just red flags. I need to investigate this a little bit more. I need to look into this a little bit more, make sure things were done correctly. Yeah,
and once
absolutely.
we get that list in writing, we can definitely share it.
Yeah.
Because we're putting that together for our own firm. One thing I want to point out, back to your question, Jeremy, it's not uncommon to not have that closing entry done, right? Like not everybody does that. The bookkeeper may not even know, right? S-election is a tax election. It has not really anything to do with how the bookkeeping is done, except for a couple things, right? Like some things that I'm picky about, like tracking officer salaries on a separate line so I can easily match it up, right? There are a couple things, but at the end of the day, the actual accounting doesn't really change. So the bookkeeper may not even know this happened. The client may not have thought to tell the bookkeeper. So if you're doing the tax return and you're not the bookkeeper, odds are that entry wasn't made. I don't think I've ever had a client come to me and their bookkeeper actually made that entry. It's just not a common thing. So what you can do is, and remember, with a single member LLC, there is no balance sheet reporting on the tax return, right? They report the P&L. Schedule C is the profit and loss from business on their personal return, but there's no balance sheet reporting. So it's not like you can go to the prior return like you can with a new to you S Corp client. So what you can do is ask the client or their bookkeeper to send to you a balance sheet comparison. That's just a balance sheet that has two columns, one for the current year or for 23. We'll use tax year 23, for example. It'll have 2023 side by side with 2022. So then you can see whether or not that closing entry was made or not. And if it wasn't, then you can kind of do it up in your work papers, right? You can see what all the assets are, what all the liabilities are. And in your work papers, you can close that out and figure out what that initial capital investment into the S corporation is.
Yeah, and if you're not doing the books in office, basically, so I think the typical sort of best practice here is for the tax preparer to prepare the return and then create those adjusting journal entries and send them back to the business owner, the client, and hope that either they or their bookkeeper will put those into the books. But you almost have to, especially if that next year you see that those entries weren't made, which happens way more often than it should. You almost have to keep your own separate financials for that business for tax purposes, right? And so now you've almost got sort of a tax basis balance sheet versus what the books are showing. And this is something we talk about in our firm. This is something I talk about with other firm owners. And this is an example of how the accounting rules are flexible and you can just kind of make them whatever you want in your practice within some guidelines. I like to see the balance sheet per books line up exactly the way the Schedule L does. I like to see the same terminology. I want to see, the Schedule L has common stock, APIC, retained earnings. I want to see that on the balance sheet. Not everybody cares about that. They're fine keeping those owner's draw accounts and owner contribution accounts and all that. Just zero out opening balance equity. That's my only hard and fast rule.
Y'all, we've talked about OBE before. No opening balance equity, ever.
Yeah. Other than that, I really, I like it when those two line up just because it helps me just kind of check off common stock is the same, in the books ended this year as it was, the last tax return I prepared. So I know either one, there wasn't a significant contribution of cash into the business. And so that means I need to adjust the basis calculations, or maybe some deposit got miscategorized, right, as some sort of equity account when it should have been either a liability account or maybe even revenue. And if it was supposed to be revenue, that's a really big issue, right? So again, just being able to compare what I put on the tax return for last year to what the books are showing as of the end of the following year, I like to make that as direct an apples to apples comparison as possible.
And a couple of tips just for some best practices in your firm. If you're not also the bookkeeper, which a lot of you aren't, I do recommend if your client is in QuickBooks Online or some other cloud-based accounting software, they can probably add you as an accountant user or as a reports only user or as some kind of user so that you can pull reports and view them on your own. If they are not working with a bookkeeper and they're doing their own books, you might want to offer to make that adjusting journal entry for them. Or if they are working with a bookkeeper, you can provide that information directly to their bookkeeper, assuming your client is okay with you talking with their bookkeeper, or provide it to the client and strongly encourage them to have their bookkeeper make that entry. Now, in full disclosure, you will come across bookkeepers who will not make tax adjusting journal entries. Y'all have been with me for a long time. You know that at the beginning, I was a very staunch opponent of forcing the books to match the taxes. Right? There are book to tax differences that just are supposed to exist. But in my years of working with you all and having these discussions, I have come off my high horse. I'm down off my soapbox, and I can very much now appreciate how powerful it is for the book balance sheet to tie to the tax Schedule L. I'm here for it. I got it. I've had too many clients come to me from previous preparers and couldn't make heads or tails. So I'm reversing my previous position. And so I do recommend that those adjusting entries get made either by you, by their bookkeeper, by the client, if you have a client savvy enough to just follow your simple debit and credit instructions, but somebody should be making them. And you could offer to do that or not, that's up to you. But as a best practice, I would strongly encourage you to have your clients make those entries and then maybe follow up with them. You've done the tax return, you deliver the return, you deliver the adjusting entries, and maybe 30 days later you check in. Just be like, hey, just wanted to follow up, make sure those adjusting entries were made. It'll make your life so much easier. Come next tax season, I won't have to bother you about XYZ, whatever. Highly recommend.
Thanks for watching. If you found this session helpful, we invite you to join our Pronto Tax School memberships. You'll get access to weekly live mentor support sessions like this one, plus tons of advanced tax course trainings, private groups, special discounts to in-person events, a tax business growth coach, and so much more. Check the links in the description to learn more about our Dream Team and Forever Edition memberships, and join us today.